Hello viewers, this is Rakesh Pujara, founder and managing partner of Compounding Wealth Advisors. Today we are going to learn how we can invest using rule-based investing approach in stock market, particularly equity market, and it's being organized by ICICI in association with Smallcase. So about something about our company, we are SEBI registered investment advisors. We as a team has more than 25 years of experience in the market, and we have leveraged a lot of technology and made the entire process of investment very systematic and rule based. We have developed various long short strategies as well, and we advise clients on index options as well, index futures, index options as well. Today, but we are going to talk about only investing systems in equity segment, and our vision is to consistently deliver superior risk-adjusted return for our client and enable them to significantly compound their wealth over a period of time. So this slide will be provided. Everything will be provided into YouTube recording and description as well. So basically, our entire approach is rule based, and we have floated this company since 2018, and journey is still on, and we are learning new things. And as we learn new things, we develop new products and roll it out to the customers. So our belief is that the single greatest edge an investor can have is a long-term orientation. So if you are investing business, then uh, the long-term orientation is such an edge nobody can take away from you, and that is what one needs to have. In the words of John Maynard Keynes, in the long run, we are all dead. Why I'm saying this? Because equity goes through some patches of non-performance. We have dig down the uh, we have done some deep down analysis in the past of Dow Jones Industrial Average and other international markets, including Indian market. And we found that time and again, market goes into the patches of non-performance. We currently, Indian markets are going through a bull phase, but in between they go through a phase of bear market or a sideways consolidation. Likewise, Dow Jones did nothing for 25 years in 1929 and 1954, and 1929, as everybody knows, was a period when there was a Great Depression all around, and that could be the reason why market fall 90% from the top, and then it took almost 25 years to recover. So we thought it's an aberration, but it's not an aberration. Again, the cycle repeated in 1966, 1982, 16 years of no return, and virtually market gyrating between high and low, and going nowhere for 16 years. So you there will in equities there will be exuberance, there will be overvaluation sometimes, some undervaluation sometimes, and sometimes market will be efficiently priced. So you have to live through all the spaces. So it's not that market was doing nothing and economy also was not doing. Economy was constantly growing from 1.1 to 2.6 during those period, and in this period from 4.4 to 6.8. Economy grew, market did nothing, went up, came down, went up, came down. Then we analyze other market also, like Japan, Nikkei index, 1989. It hit a top of 13.260. And then, as of today, the index is hovering around 32,000. So after 34 years, market is still below its all-time high. And see the fall it show, then the rise, then the fall, then the rise, then the fall. And now it's continuing its uptrend from this. So people who entered here would have witnessed kind of a bull market. But people who entered here actually whole their life, they saw was a bear market. So depending on where your entry is, your experience can be different in equity markets. And that's where it's very important that we understand what cycle we are into equity market before allocation is made to the equity market. Same thing happened with Shanghai. Shanghai has made a top of 6,100 in 2007. And as of today, the economy has grown almost by 400%. Like 3.55 trillion economy has gone to 17.7 trillion. 398% growth in 16 years. Still market is 50%. So Anybody who presumes that a growth of economy will result into growth of market will have to think twice because it may not happen so. Fortunately, in India, most of the growth is getting converted into listing space earnings, and that is why you are seeing this kind of a stupendous rise in the market. And see the amount of pain that investor has go through during those periods. Okay, this is the Dow Jones price and drawdown from 1885 to 2010. So almost 135 years analyzed. Market regularly falls 40-45%. You see this spike between 40 and 50. Regularly it falls. Even during Corona call, you must have witnessed market fall by 55% in Dow Jones. And in between, market fell 90% in 2000 in 1929. So as you can see, from 90%, it saw it recovered almost to 50%, and then again it went to certain. So this is the kind of risk that one is taking when it is entering equity markets. Still, the risk looks worth taking. Why? I'll give you some data which will convince you that this kind of gyration happens. Still, it makes sense to make some allocation to equity markets. Even Indian equity market, initially it grew by four times, and then from 2000 onwards till 2008 it did nothing, and then from 2009 onwards again it rose, and then from 13 to 17 onwards it did nothing, and then 17 onwards again it is rising. So in Indian markets also we have seen non-performance patches of 5 years, 10 years, something like that, and then suddenly market rise 4.5 times, 5 times in within no time. So uh, it's very important that we stay in the market when this happens, okay, so that you know the pain that we have taken during those periods are rewarded properly. Most of the time, people get influenced by the recent performance. They enter during this phase and then exit during this phase, and again try, after some performance comes, they come. So from top to top to top, from bottom to bottom to bottom, selling it bottom, buying at top. That is what the experience of many people is. But see, let us see what are the return profile of various asset class. In last 20 years, this is the slide that we have found that as on 31st March 2023, equity has delivered 17% return for 20 years. US equity has delivered 12%, gold has delivered 12, real estate 9, and debt has delivered 7%. So, equities, Indian equities particularly, has turned out to be a clear winner. But some people might argue that these are the times when markets show a lot of bull activity last 20 years. Let us see what has happened in the past for say more than 200 years. The next slide will show you the returns of various asset class for 217 years. This is the data of 217 years starting in 1802 till 2019. Okay, that is the data. The slide shows what is the annualized real return. Okay? Real returns means returns minus inflation. That is what the real returns are. And real returns of stocks are 6.8%, bonds are 3.5, T-bills 2.6, gold is barely positive, and dollar is actually negative. Okay, these are on an annual basis. If you are holding only dollars, probably you are uh, depleting your value. Okay, and if you're holding your stock, you are actually increasing your purchasing power as well as you are increasing your wealth as well. $1 invested in 1802. Let us see how they have fared in 217 years. So after adjusting for inflation, $1 invested in US dollar is 0.04 cents. And virtually your value has eroded. If somebody has put cash in the cupboard and today opens the cupboard, the value would be around 0.04. Okay. And uh, dollar has become 3 times. Okay. T-bills have become 264 times. Bonds has become 1746 times. See how the stocks have become. It has become 16 lakh times. $1 is 16 lakh, 1.6 million in 217 years. So this clearly shows equity has generally outperformed all the class, but there are patches of underperformance, and outperformance, and that is why you need to invest in equities for a very, very long period of time. Equity is not a short-term game, but it definitely generates very, very superior return. This is the amount that should be kept in mind, and that convinces me that one should be allocated to equities all the time. Maybe some percentage less, some percentage more, but one should be definitely allocated to equities all the time. So when you can invest in equity probably through three methods that we have identified. One is you go through ETFs, इंडेक्स इन्वेस्टिंग, पैसिव इन्वेस्टिंग, म्यूचुअल फंड में ETF में जैसे निफ्टी है, ऐसा इंडेक्स में आप इन्वेस्ट करिए, और यू कैन इन्वेस्ट थ्रू म्यूचुअल फंड विच आर डायरेक्टली investing in stocks. Okay, so this is the category under this slide. The third way is you invest directly yourself, okay, in equity. And we have analyzed some data of last 12, 13 years, okay, how this thing would have panned out if you had done your investment in ETF buy and hold approach. So your return would have been in the vicinity of 13%. Okay. And what would be your drawdown? Your drawdown would be in the vicinity of the maximum drawdown was 39% and average drawdown was between 15 and 16%. Okay. So there is one ratio that we calculate always, which is average annual return divided by maximum drawdown during this period, backtested period. This is the backtested data. And this is done more for educational purposes. And a standard disclaimer, this is neither a recommendation or nothing, it is for educational purpose. And one should consult their investment advisors before taking any decision. So that's a standard disclaimer that as a SEBI registered advisor I need to make. And let us see how much would a direct investment in mutual fund which invest in equity would have delivered. It would have delivered around 19% on an during the same time when Nifty has delivered 12%. But mind we have picked up only top performers. Okay, so we presume that you are a good mutual fund because or your advisor is good enough to recommend you top mutual funds. Okay, even then your return would be 19%, and your drawdown during the same period would have been 34% maximum. Okay, third one. Let us see if you're a smart stock picker, what would be your return? Your return would be in the vicinity of 27%. Okay, during the where you would have picked up some good multi-baggers. That is what we presume, and your your drawdown still would be around 40. So in all three approaches, drawdown is between 35 and 45%, and return is ranging from 12% to 27%. Then we calculated the ratio. Let us see what is the Kalmar ratio of ETF. If your average annual return is 12% and drawdown is 30, your Kalmar ratio is 0.3. What is the ratio, formula for Kalmar ratio? Average annual return divided by maximum drawdown. Okay, and higher Kalmar the better. Okay, so let us see what is the Kalmar ratio of a portfolio direct investing on stock. That is, the Kalmar is around 0.59 because the return is 27 and drawdown is 45. Okay, and mutual fund Kalmar is around 0.56. So 0.33, 0.56 and 0.59. 0.59 is better than 0.56, 0.56 better than 0.33. So this is our rule-based investing model, and this is the statistic of that model. Same period, same backtesting method, everything same. We just compared how would have the system performed during the similar period. The system would have performed 37%, and maximum drawdown that it would have encountered is around 24%. So the Kalmar is 1.46. This is the benefit of following system, and will gradually uh, as the slide goes forward, we will gradually explain you how to go about rule-based systematic investment. Okay. So now, by now we are convinced that direct equity investment is better. And if you go rule-based investing, system-based investing is all the more better because of the concept. Okay. So what are the challenges that a direct equity investing has? Like extensive research and analysis is required. If you actually invest in your market, you have to devote a great deal of time, energy, manpower, and resources. Then you have to track global macros, industry headwinds and tailwinds, like which industry is good, bad, structural trend, cyclicality. You have to whether metal is cyclical, for example. IT is performs in a different environment. it is defensive. Pharma performs in a different environment. Again, it's a defensive. So you have to analyze a lot of sectorial trends, cyclicality, business fundamental, individual company, more than 5, 6 thousand listed companies on Bombay Stock Exchange. And you need to know fundamentals of, you are expected to know fundamentals of each of them. It's practically impossible. Estimating long-term longevity of the business, like whatever business you are invested, ultimately stock market is not a speculation. It is an investment activity in real businesses, which does some economic activities to generate profits. Okay, complex financial analysis and valuation exercise. Again, valuation, there are no set rules. Probably it's more an art than a science. And after doing all this, you have to again assess the quality of management. Okay, the recent example, for example, the fiasco that happened with Paytm, because of some regulation error, the RBI canceled their license and the stock is on the ninth spin. So until 2 days before, Paytm was looking to be great business to many fund managers, but suddenly now it is hitting lower circuit because of the regulatory uncertainty that is facing today. So you have to assess all this. And for a lemon like this, it's very difficult, continuous monitoring and tracking and all that. After doing all this, we have our own likes and dislikes. Some people like some company, some people dislike some company. So they will objective analysis will take a back seat and their personal likes and dislikes will take a front seat. So all this leads to subjectivity and discretion. Okay, which industry to buy, which sector to buy, what universe to take, which particular stock to buy, when to buy, how much to buy, how long will you ride the winners. Most of us like end up booking the winners and holding up the losers, and that is how our expectancy is reduced. Okay, and how long before you cut your losses? Difficult to test and validate all this investment hypothesis, and because of the constant gyration of portfolios, your emotional turmoil, analysis paralysis happens, information overload. Today in the world of social media, a lot of information overdose is there, and you lose your patience all the time. You go through a lot of emotional turmoil. So let us see one more challenge in direct equity investment. So we have seen that equity market performs in patches. Sometimes in 3 to 4 years it goes 5 times, and sometimes for 10 years it does nothing. Okay. Market timing is very, very difficult. Investor who allow their emotion to get best of them may suffer lower returns. And there is a research by Wells Fargo, okay, which says that if S&P, this is between 1992 and 2000, so around 30 years, if S&P 500 index has delivered 10.65% return, in average investor have got 7.13. What is the reason for this gap? This gap because people have tried to time the market, okay, and that has resulted into less, almost 3.5% less result than S&P 500. And let us see why this happened. If you if you miss the best days in the market, okay, so again 30 years of index data. Suppose your S&P 500 return is 7.82 percentage, okay, and if you miss 10 days, then your return drastically reduces. Again, if you miss 20 best days, if you miss 30 bad days, if you miss 40 bad days, and if you miss 50 bad days, your return is negative. So out of almost 30 years, which is 7,500 of trading working days, if you miss only less than 1% of best days, your return turns negative. So that kind of establishes the need to be in the market all the time if you want to realize the average return. And if you try and time it, and if you take an exit at the wrong time and all that, your return might suffer. The problem with missing best days is that it happens during worst times. Okay, so bad days and worst days actually they happen in clusters. You see this 2000 2002 best days, four best days and one is probably a worst day example. 2008 there are a lot many worst days and lot many best days. So best days and worst days have often occurred together, and that results into further less research. Let us read the tweet of Michael Burry, very famous personality. If you have not seen the Big Short movie, you can watch Big Short movie. He made his fortune in 2008 subprime crisis. Okay, he said after 2000 the Nasdaq had 16 bear market rallies, 16. Okay, which are greater than 10% and averaging 22% before bottoming at 78% down. Okay, so market was actually going down and down and down, and it settled at around 78% down. But in between, there were 16 rallies, which were averaging 22%. So in between bear market also, it looks like a bull market when the rally happens. After 1929, Dow Jones had around 10 bear market rallies, averaging 22.8% before it settled down at 89. So journey is not very smooth. It's very topsy and turvy. That is why it's important to have some sort of a methodology, right? So we'll try and understand what kind of method we can deploy. Now let us see if we miss both best and worst days, what is our expectancy? Then our expectancy increases from 7.82% average return to 8.8%. Idea is to miss both worst days and best days and reduce exposure during market volatility. So you can put some sort of a market volatility filter, reduce your exposure and try and improve your dot by avoiding. Of course, best days will also be kind of missed, but worst day also will be missed and your expectancy will improve. Okay, of generating higher return. So against all these ads, we have analyzed the merits of systematic investing. What systematic investing does is remove subjectivity and discretion with regard to universe of stocks to buy, timing of entry and exit, position sizing, risk management, money management. Everything is predefined in systematic investment. It automatically leads to diversification such that particular stock does not make or break any P&L. This leads to sector agnostic portfolio from free from biases, and this process results into clarity of thought and peace of mind. Okay? So everything is clearly defined in systematic investing. How did we at CWA, the CWA is basically my company, Compounding Wealth Advisor, solve these challenges? We have developed a process-driven approach towards stock investing. We have developed several systematic investing uh, involving extensive use of quantitative parameters, technical analysis and price action concept, which we have listed on Smallcase platform. My microsite is cwa.smallcase.com, where you can go and check our portfolio performance. And these systems are designed to let winners ride and cut out. See, most of the people like end up booking profit too early and hold on to the losers very fast. So we have actually cut down on this, and we have framed rules around the systems which allows you to ride your winners and cut your losses short. Okay, and but we have leveraged it's very convenient. Click of a button, you can actually subscribe to our Smallcase, and uh, it can make portfolio in one click. Okay, so we have, and again we have backtested for last 12, 13, 14, 15 years, and our portfolios are live from 22nd March 2023, and this strategy uh, has actually tracks thousands of stocks over a period of last 12 years. Okay, and robustness checks have been performed on this rule-based system. These are the statistics, back-tested strategies. These are the six portfolios that we have listed, and before we launched, this is the statistics. Okay, last 12 years, average Kalmar of more than one in each case, like 41%, 33%, 37%, 37. This is large cap, which has delivered less return with lesser volatility. And this is the equity curve of all small cases combined. Okay. So small cases, basically, if you subscribe to all small cases, what would be your experience in the past? What would have been your experience? That is a back test. Okay. And see, you could have probably experienced 30.87 CAGR with an average return of 32% with a maximum drawdown. So for me, reducing risk is the key. Maximum drawdown of all six small cases combined is only 20%. Why this has happened? Because of the diversification that we have done, because of various logics inputted into various strategies. Plus, it has happened because exposure in the market is only 68% of the time. and the Kalmar is 1.50. When I say exposure in the market is only 68% of the time, it essentially means that we are sitting on liquid 32% of the time. And the sharp of all the six small cases together is 1.57. This is the drawdown curve. And so, yeah, how you'll be able to subscribe to these small cases? So probably you go to ICICIdirect.com and go to stocks there, and then probably you can subscribe. I can just show you right away, and then probably we can go back to the slide. ICICIdirect.com. You can, okay, you once you log into your ICICI this thing, you go to stocks there, click on the stocks, and then smart tools, and then go to small cash, and then you will find go to the managers, and you will find compounding wealth advisors here. And these are all six small cases that we have. Uh, these are the returns live from 22nd March 2023. Okay. And probably you can go there, click there and subscribe. Okay. Like this is our top performing CW Everest 10, second best being around all cap, and third best is Milt, and all these are the soft six small cases that are listed here, right? So
Why screen is not visible, sir?
screen is not visible. Okay.
Yes, that PPT is visible. Only PPT is visible.
Only PPT is visible. Why the screen is not visible?
So can you unshare the screen and then share?
Yeah, top share and how is visible?
Yes, yes, sir.
So basically, you log into your ICICI Direct.com website, then go to something called stocks here. Okay. Then go to smart tools. There is an icon called small case. You go there, and then you explore manager. There you will find compounding wealth advisors, our small cases, and this is our website. This is our profile and all. And these are the six portfolios that we have listed here, and the top performing big CW Everest 10. And you can see these are listed from 22nd March 2023. Live performances are there. You can subscribe to ICICIdirect.com. So I hope you, and the same way you can actually go to your app as well and subscribe. App mein there is an icon called stocks again, and go to the stocks, then scroll it down, go to the connected apps, and then there is an app called Small Case. Go to the Small Case, and then probably you'll be able to connect directly and Small Case in the where you have all the my portfolios are listed. Okay. Just to give you a glimpse of what kind of system we have made and how the portfolios are made, we have uh, given away one strategies free of cost to all your users, and you can actually. I'll give you the rules of the strategies now. What are the rules and how we have developed this and what could have been your returns and all. So give me a minute. I'll just yeah. So we call it CW2 Sigma. We have developed an indicator called CW2 Sigma indicator, which you can subscribe absolutely free by filling up Google form that will be provided in the description link of this video. And this is only for educational purpose, just to give you a glimpse of what kind of investment activity we do and how what kind of return it has a potential to generate. And you can subscribe absolutely free. There is no charges on that. Universe is NSE listed script around 1,500. We will hand over those lists to ICICI people, and they will put it in the description link for you to analyze those scripts. What is the position size? Position size is the 2% of capital. So, for example, you have 1 lakh rupees capital and the signal comes to buy, then probably you put 2,000. Okay. So, by this logic, you will have 50 stocks in the portfolio, and your uh, after portfolio is full, any signal that comes as a buy signal should be ignored, unless there is a sell signal on some stock and there is a space to buy more. then you buy more. Otherwise, you don't go above 50 stock. What are the entry rules? Weekly close above upper Bollinger Band. Setting is 50 and 2. Usual setting of up Bollinger Band is 20 and 2. But in this case, you'll have to change the setting from 20 to 50. Okay, this is the entry rule. And what is the exit rules? Exit rules is initial stop loss is 20%. So suppose you enter one stock at say 25 rupees and that stock closes below. So this is the weekly system. So after market is closed on Friday, you basically let the closing price updated in the data and then run the scan and load this indicator on TradingView. This indicator is available on TradingView and you have to fill in the Google form. And once you fill in the Google form, we will enable you to access this, and this indicator will be visible as a invite only mode. I will show you that journey also how it will look and how you can actually go and plot this indicator. So let us understand the rules first. Entry rules is weekly close above upper Bollinger Band 50 and 2. 50 is the setting of Bollinger Band. And exit rule is initial stop loss 20% or closing below 100-week exponential moving average. Okay. And the third is closing below average true range. And the average true range setting is 14 and standard setting is 40 and 1. And we have modified the setting to 14 and 1.8. So once you have these clear rules, you will be able to ride the winners and cut the losers, and there will be no subjectivity, and you'll be able to check your portfolio with this indicator or probably create your portfolio your own using this indicator. Okay, and some examples how this indicator has picked up good stocks at good price. For example, it picks up a lot of multi-baggers, and uh, one of them is CG Power, which it picked up at around 23rd October 2020 at the price of 25.95. And the initial stop was 20 rupees, which is the initial 20%. And then it is trailing. What is the rules? It has closed above upper Bollinger Band, and that is why, and closed on Friday. So this is the weekly chart. You have to follow on weekly. Okay. And it has closed beyond upper Bollinger Band. And from that day onwards, it has never actually gone below either average true range or initial stop loss or 100-week moving average. And the stock currently is around in the vicinity of 450 and still it is holding. So around 1,005 for 488% of gain. One more stock is an example, Avanti Feed. It picked up at around 15 rupees 20 paisa on 13th September 2013 and it sold at around 515 rupees on to almost 5 years. So basically, it's a purely investment indicator which you can use to evaluate your own portfolio, check your portfolio entries, exits, stop losses, and all that. It's not that it's only picking small cap and mid cap. It picks up something like Britannia, which is a large cap and a blue chip company. It picked it up in 2013 at a price of 283 and it sold at a price of 3,114 rupees. So again, 5.5 years and almost 1,000% gain, and then it exited. One more example, Indocount ICICI picked up at 3 rupees 70 paisa and sold at 192 rupees within a short period of around approximately 3 years. So this indicator constantly picks up a lot of multi-baggers. Probably you can use it for your portfolio, and this is the back-tested data of this indicator. If you had constantly made portfolios from 2011 using this indicator, 50 stock maximum, 2% capital allocation, what would be your return? It would be in the vicinity of 25%. Your average annual return would be around 31%. And number of trade, just see the number of trades, only 639 trades. Okay. In what, 12 years, 639 trades? It's like 50 trades a year and it's almost 3 to 4 trades a month. Okay. Average trade per month is only four. See the average holding period, 769 days. Okay. And what is the percentage of winning? 134%, of losing 14%. When you lose, you make 135. When you lose, when you make actually 135, when you lose, it's only 15%. The payoff ratio is 9, very, very high. This would be the holdings if you are following this indicator as on 15 December 2023. See the date of entry, date of purchase, current price, and the gain. CG Power is still holding, HBL Power it is still holding. Uh, Price is up almost 2000%, here 1600%. Many 100% plus winners. Of course, it's a bull market, so definitely this kind of winners will feature in only in bull market. But still, if you are in bull market, if you do use this, probably you'll be able to participate and make the most of it. Then we have done some sensitivity analysis, portfolio churning and tax efficiency. Slippage sensitivity. Portfolio churning is around 8% per month. Slippage, suppose we have accounted all the back tests, we have taken 1% slippage. Suppose your slippage increases 2%, what happens? Then also you have a decent return, like that 25 or 22 who is not that. Basically, the edge is not only because of non-slippage or a less slippage or a less transaction cost, it is because the system has an edge. 1% slippage has resulted into 25% CAGR, but 2% slippage has reduced the CAGR by 20, say 2.5%, which is a decent. And maximum drawdown again around 40%. Portfolio churning is 8% per month. It's a very tax efficient system. Why I say it's a tax efficient system? So the average holding period is around say 750 days. But see the average holding period of winners. Winning trade ka average holding period 1365. It's almost 5 years, 4.5 to 5 years of holding period, and average losing period is less than 300 days. So your losses will be short term, your gains will be long term. That's why we call it a very, very tax efficient system. And we have developed this scan, and you can actually scan this and apply for this indicator absolutely free. And we will give access once you apply for it. And you will have to be patient for a couple of days because there are restrictions on how many people can apply and how many people can get an access. You have to fill in the Google form with correct details. Many people actually uh, oh, forget to put the correct TradingView ID, and that is where they don't get access. If you don't put a correct TradingView ID, if you don't put an email, if you don't put a mobile number and name correct, you won't get an access. Make sure that all the details are correct, and probably then you will be able to get an access to it. Okay, and this is what my contact details are. Whenever you want to reach out to me, probably you can use Twitter. I'm very pretty much active on Twitter. So it's our WhatsApp and email, whatever medium you like to have. Probably we can connect with each other. Uh, I'll take you to the TradingView website and how you can actually uh, load this indicator, and I'll just demo that also as well. Let's go to TradingView website. So this is not a paid promotion of TradingView. It is just because we have coded this indicator on TradingView. That is why we are demonstrating. And you can actually TradingView free version works with that. You don't need to subscribe. Free version you can work. Go to the TradingView, and then you are able to see my screen now. TradingView.
No, sir, I can't.
You can't. Okay, so I have to disconnect that PPT first, and then connect with the TradingView. Disconnect the PPT first. Disconnect the PPT. Share screen. This is visible. Okay.
Yes, it's visible. The screen is
Okay.
visible.
So go to the weekly chart first. Okay. Go to the any stock you would like to verify. Any stock. Anybody. Let's check uh, RVNL, for example. RVNL. Okay. You have to go to indicator. Once you apply for indicator in Google form, we will give you access. The moment you get an access, there is something called invite only script. Okay. Otherwise, the community, your trading view ends here. Once you have access to our indicator, there will be invite mode that will be active. Go to invite mode. and then click on the CWA2 sigma, and it will get loaded. Okay, this is how it works. Remove everything else. Mm. Okay, this is how it looks. The last signal that has occurred on RVNL was here at a price of 116, and then it got an exit here at a price of, the buy price is here around 38 rupees, and then it got an exit around 120. Now there is nothing. Probably you can check other stocks as well. SJVN, for example, it was very SJVN. Let's see how it, when it caught it here and stick around 40 rupees, and the today's price is 148 rupees. This is the upper Bollinger Band when it closed, and then it is still riding the profit. The trailing stop losses are very, very far, and average true range again, if it crosses below that, it will give you a sell signal. So this is how you can track, and this pretty much ends my presentation, and I am open for questions if you have any.
Hello, sir.
Haji.
Thank you for this insightful session. So
Thank
we
you.
have a few questions lined up.
Yeah.
So first, Aditya is asking, the Indian stock market is near its all-time high. Can we
Right.
expect further growth in the long term?
So yeah, I showed you in my slide, like what is the long term. So yes, it is an all-time high. The market is not about absolute price; it's about valuation also. Since Indian economy is growing, its earnings are increasing, and that is the market are increasing. Stability at the center, very very good governance by the government, and probably we are entering an era where your per capita income will increase, your GDP growth will increase. So we are in for a very long period bull market. But bull market does not mean that you will not have correction. You will have correction in between, but it makes sense to, uh, as I showed you in the slide, it makes sense to be in the market for a longer period of time. You can stagger your purchases if you are finding it difficult to enter now. Suppose you have not entered so far. So you can stagger your purchases, you can go in SIP mode and all that. But it's important that you participate for the next 10, 15, 20 years to create a significant generational wealth for you and your family.
Thank you, sir. So next, Nishant is asking, actively managed funds in the United States have not been able to beat their index in the last decade. What
Right.
is the trend in the Indian equity markets?
In Indian equity markets, yes, there are few funds or PMSs that will struggle, lag behind the passive. But believe me, in India, like more than 7,000 companies listed, you will have lot of companies which will outperform index, and it makes sense to deep dive into these and do some research. So if they're not able to do your research on your own, probably you can take help of the expert you like, or expert like us also are available if you want. Uh, you can subscribe to small cases if you want, or suppose you want to do it yourself, you can use this indicator I've given you for free. But it makes sense to actively manage, be extremely nimble-footed, because as a retail investor, we do not have compulsions to go only for large cap or enter where only there is a lot of liquidity and all that. As a retail investor, we can actually pick up a lot of small and mid-sized companies which are going to grow as the GDP moves from 3.7 trillion to 5 trillion to 10 trillion. So yes, but you need to be agile on your toes, and do your active portfolio management. If you're not able to do it yourself, outsource this to the expert. That's the best way. But I think the smarter people will outperform indexes, and the only job is to find out who are the smarter people. Okay, so you do some research, and probably you'll end up finding a lot of smart people in India, and you can take your advice, take their advice, take their professional service, and probably outperform an index as well.
Thank you, sir. So next up, we have an question, IPO related question. Mohit is asking about your views on the Jana Small Finance Bank and Capital Small Finance Bank IPO.
So banking as a sector uh, forms around 35% of index. Okay. So if any economy has to grow, has to have a robust banking system, which we have established, robust. very robust infrastructure, soft infrastructure we have for lending and repayment as well. And small and micro, yes, they have penetrated tier two and tier three, and probably a good and efficient micro cap finance company will definitely perform better because of their names and all. They have a better names and better reachability, and ticket size is very small, and generally even NPS are very less. So ultimately, yes, they will also grow. The entire ecosystem will grow, and banking is the backbone of growth of economy, and it makes sense to remain invested.
Thank you, sir. So next up, we have a question from Chinmay. He's asking how important is diversification while investing, and which asset classes should we consider for such diversification?
So it's very important because the holy grail is diversification, not the strategies. Okay, it's very important that first of all, it's important to protect your wealth. Suppose your wealth goes down by 20% and your wealth goes down by 50%. There is whole lot of a difference. Okay, so if you in a downturn, if your wealth goes down only by 20%, you need to actually reclaim only 25% to get back to your 100. But if your wealth is down by 50%, actually you need to do 100% to reclaim your old wealth. So it's important that your drawdowns are very limited. That is why it's important that you diversify across asset class, because it's very difficult to know in advance like which asset class will perform better and which asset class will not. So if you're an aggressive investor, you can remain like depending on your age and cycle. It's not a standard formula, but you can allocate major portion to equity, then put some amount in gold, some amount in gilt, and keep some liquid for rainy days. This is the kind of diversification one should do, and of course, you can actually use options also to generate some additional return out of this, but that is the topic for some another day. That is not today's topic. So yeah, it makes sense to diversify. Diversification, of course, dilutes the return, but it also protects your capital. So it's very important that you protect your capital in your wealth creating journey.
Thank you so much, sir. So I guess all the doubts are very clear. And thank you for this insightful session. We have learned a lot about the equity markets along with the opportunities and challenges associated with the investments.
Yeah, see, and don't forget to put that Google form and your tracking list into the description link so that your user can avail benefit of it, right?
Yes, I will put it shortly. And
Okay.
just we have a final question from Prakash. He's asking your views on Gale.
Gale has been constantly featuring in our cans. Like we produce the market outlook every week, and it's featuring in our since last 3 4 months. And fundamental, I don't track, but on a price action basis, I think it's looking very strong. And yeah, we are bullish on Gale, and we might have recommended to our clients, or we might be holding as a part of our small cases. So that is a standard disclosure. But yeah, we are bullish on Gale.
And Acharya is asking how to identify the right stocks for long term. Hello, sir.
Yeah, I lost your voice in between. Yeah.
Oh, sorry. Yeah, Acharya was asking how to identify right stocks for the long term.
So there are two ways to identify. Either you follow fundamentals or you follow price action technicals and all that. We don't follow fundamentals. So for us to identify a stock, the price has to perform. Once the price performs, it comes into our radar, and price is the only basic indicator for us to follow that stock for a longer period of time. Fundamentals we don't track, so I won't be able to make a comment on that. So anything that moves, probably that comes into radar, and then we have our portfolio management rules, as I explained you earlier, like how much to allocate, which stock to allocate, how much to hold, and all that. So uh, it's important that people learn this concept of price action and trends and momentum and all that, and that will help them to create their long-term wealth.
Yeah. Thanks a lot for the session, sir, and thanks a lot for answering all our queries.
Thank you.
This
Thank
was
you.
a very good session.
Thank you.
Thank you.
Thank you so
Thank you,
much,
everyone.
sir.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.